Hello, good morning and welcome to ET Now's Buy Now, Sell Now with me, Varun Hirimat, and along with me, Cheryl D'Souza. Cheryl, great to have you with us on the show this morning. It's a rare sight to have you on BNSN, so welcome to you. With that being said, let's get a move on with our headlines for this morning. And beginning with that, the highly awaited future retail Reliance deal seems to be going down tomorrow. The Future Enterprises Board will be meeting, and it seems that it's going to be an all-cash deal, which will see Reliance taking on Future Group's debt as well. So really interesting transaction. Both those counters in focus, the retail space in focus. A keen one to look out for this morning, Cheryl.
Absolutely, Varun. Apart from that, you have HDFC Bank, you have IndusInd Bank as well as Kotak. FTSE won't include these banks in its indices. The reason slated is that they fail to meet the minimum foreign headroom requirement. So that on back of that particular news, you have HDFC Bank, IndusInd Bank as well as Kotak Mahindra Bank that will be in focus.
Right, definitely in focus, not for the best of reasons, but nonetheless, they seem to be holding up pretty okay this morning. Coming back to the deal space and M&A activity, a deal has been sealed, and PAG is to buy a majority stake in Edelweiss's wealth unit. We had Rashesh Shah on the channel this morning talking about the transaction, talking about how it's not about control, but really about delivering shareholder value. And that's got the Edelweiss group in focus as well this morning.
Yes, is another stock that is in focus. You have Goldman Sachs that's upgraded the counter to buy from neutral. They've also revised the target to 2,598 rupees per share. That implies a 16% upside on the particular counter. Goldman Sachs is saying they expect TCS to see a sharp improvement in margins over their peers. They've also gone ahead and upgraded HCL Tech as well.
Some big upgrades coming in for the larger tech companies, and it seems that the dollar index might have something to do with the way those earnings are projected. But coming back to the dollar and the USA, strategy shift. Last night we had the Jackson Hole address where the Fed Chair Jerome Powell announced a massive shift to average inflation targeting, which basically means they're going to allow inflation to be above 2% before they decide to hike interest rates. So typically this would have warranted an interest rate hike. But for now, the USA is not going to do that. They're going to try and do the best they can to keep the stimulus flowing and support the equity and asset markets.
You have Chris Wood, who's come out with a note, who is saying that he sees room for oil to rise relative to the gold. He's saying it's an interesting point about oil, that is the demand has fallen much less than predicted. He's saying recovery in demand has actually gained momentum ever since that drop. So that is what the Chris Wood is saying. He's saying, nevertheless, will not recommend selling gold due to the strength of the long-term, due to the long-term story. So that is the word coming in from Chris Wood.
Okay, and with that, that was the headlines for this morning. Let's quickly take a look at the markets. We're doing quite well. The breadth on the Nifty is very much in favor. You have 34 stocks advancing and just 16 declining. The Nifty is up a solid 0.5%. So now we've firmly crossed 11,600 and we're trading above there for quite a while. The next 50 is up as well. The mid-cap index continuing to outperform. Broader market rally up 1.13%. So nearly double the gains on the Nifty are seen in the mid-cap 50. The auto index today, a bit of a loser, down 0.5%, 0.5%, excuse me. Bank index shining 2.29%, and just look at that. The three leaders this morning, the highest gainers are the Nifty. Axis Bank 6%, IndusInd Bank up 4%. This is despite the bad news we just got. SBI up nearly 4%. Then you have Infratel and Grasim also today doing quite well. On the losing side, we have Tata Motors finally cooling off from that rally we've seen. Asian Paints also ebbing off a little bit, 1.20% down. JSW Steel down 1.5%. Hindalco down nearly 1%, and Power Grid down nearly 1%. So I'd say we're holding out pretty firmly. Banks have been absent for a while. They seem to be performing today, and slight cool off in some of the stocks which have been rallying tremendously in recent times. But to get more insights on the market, let's cut across now to our experts. Both Kunal Bothra and Sharmila Joshi are with us. So good morning and welcome to the show to you both. Kunal, as always, coming to you first. What's catching your eye in the market this morning?
So good morning, Varun. I think the market mood remains the same, extremely buoyant. Today we've seen a very strong breakout coming on the Bank Nifty front, and we've been highlighting all the viewers as well on the show that how this is the index to watch out for, we anticipated the breakout much earlier, and believe that at current levels as well, it looks extremely strong from current juncture, whether it's the individual stocks you want to bet on from the Bank Nifty front, or whether it's the index, which I believe traders should still be looking to bet upon. So we look at it this way, that many of the individual components of Bank Nifty are nearing the breakout above the 200 moving average, and generally the index tends to mirror what happens to the individual stocks. So I think in that regards as well, I believe that there could be a case for the Bank Nifty trying to challenge its 200 moving average. So I think that itself could lead to a very strong upside from a near term. So I maintain that stance, that the index remains buoyant. So Nifty may remain more or less, an underperformer as compared to Bank Nifty. Now there are two stock ideas which I would want to stress upon. I've been highlighting the couple of names for the last couple of days. First one is a buy on Shriram Transport. I believe that stock has shown signs of a very strong inverse head and shoulder breakout. Now, surprisingly or interestingly, this is a inverse head and shoulder breakout, which is not a reversal breakout. It's more of a continuation breakout, which is generally a bit rare to find for such kind of high beta names. So Shriram Transport is a buy. Short-term targets now revised to almost 800. Stop loss could be trailed to 735. The second would be a buy on SBI. Now, I had given this call in the morning show as well. I believe that at current levels as well, 223, 224 for SBI, I still believe that there seems to be a strong upside from a current level. So my intraday targets have been hit, but I believe now from a fresh positioning perspective as well, traders could look at a buy on SBI, revise the targets to 240, and stop loss could be tailed to 215.
All right, and those are the picks coming in from Kunal this morning. Buy on Shriram Transport as well as buy on SBI. Good morning, Sharmila. This is Cheryl on the other side. What are your top picks this morning for our viewers?
I would agree with Kunal as far as, the interest in the NBFC space goes. My advice here would be, sort of de-risk yourself and buy a basket. And I'm going with slightly sort of lower price stocks than a Shriram Transport. I'm going with Cholamandalam Finance, M&M Financial, and L&T Finance. And I think all three are sort of, they're differently positioned in the NBFC basket, with M&M having a slightly more rural, leaning. And we know that things on the rural side of the economy are doing better. Cholamandalam, again, a South-based company with a good mix in its book, and L&T Finance, again, in a different sort of a financing field. So I think it would be a good idea to sort of have a basket of all three. Another mid-cap that I'm liking at this point in time is Gujarat Gas. We are seeing that the National Green Tribunal decisions have played out in favor of gas companies, and we are seeing the benefit of that in Gujarat Gas numbers. Also, there seems to be a push overall for greater use of gas, both in industry as well as automobiles, and that also, especially industry, and that's going to play out very well for Gujarat Gas going ahead. So I think long-term investors can look to buy a Gujarat Gas with a sort of a 15 or 20% upside.
Thanks for that, Sharmila. Let's now get a move on with our queries for this morning. Beginning with the first one, SBI Life. Rakesh Malani from Mumbai has written to us, and he's bought SBI Life at 860 rupees per share. Should I hold or sell? So, Kunal, what do you think Rakesh should do?
I think you should hold on to your investments on SBI Life. I think it's a very strong, chart as well, strong stock. The stock has done exceptionally well from 500, 520 kind of levels from the March lows. The stock had rallied to almost 900-ish. It's now consolidating. I think the entire month of August, many of these insurance names, whether it's SBI Life or ICICI, Pru, ICICI General Insurance, as well as HDFC Life, I think these are the predominant names. These stocks have remained a bit sideways, but that's but natural behavior for these stocks. After a steep 3-4 months of price upswing. So I think the chart prospects looks attractive. The stocks are going through a time-wise correction or time-wise consolidation, and I believe that you should hold on to your investments on SBI Life, provided you have a time horizon of 6 months plus. I think if that's the kind of time horizon you're looking for then I believe that the stock has potential to climb up even to those 1,050 levels, which I think, if I'm not wrong, is very close to its all-time high. So I think have a time frame of 6 months plus and hold on to it.
The call coming in from Kunal for SBI Life saying the charts are looking strong. He expects the stock to touch 1,000 in the next 6 months at least. Sharmila, what's your take on SBI Life? Is going to be entering the Nifty pretty soon, and considering how the insurance space is also panning out, does it make sense to hold on to SBI Life?
Well, I've been positive on life insurance as a space for the longest time. I think there was just a short period in between, around budget times, when certain announcements were really not in favor of really people investing in insurance, that one sort of wanted to wait to see how that would go. But then we came into this whole pandemic situation, and what we've really seen is that people have reevaluated their insurance options, and they've pretty much like rolled them over or bought more insurance. And we've seen that play out in LIC numbers, and there's no doubt that it will play out in the numbers of private insurance companies as well. So once again, I'm positive on SBI Life. Here again, I think it would be a great idea if you could build a basket if you haven't got any in SBI Life, HDFC Life, and ICICI Pru Life, because all three have certain things working for them better than the other. And really, I think if you have SBI Life, just continue to hold it.
Sharmila as well on SBI Life. Let's shift focus now to another query that we've got, and this is from Girish Sule from Navi Mumbai. He's saying that he wants to know the views on Infosys, and he wants to know whether it is the right time to enter this particular counter. Kunal, I'll come first to you on Infosys. We've seen the tech stocks rally post this pandemic. We've seen how they've performed, but do you think it is the right time to enter Infosys?
I think it's a perfect time to enter Infosys. So I understand the anticipation of the viewer as well, because the stock had run steeply. I think in the month of July, I think there was a big gap up day when the stock from 800 had jumped up to almost 900 or 880 something, almost a 10% kind of up move, and that gap has not been filled up for Infosys. So there is a natural anticipation that maybe the stock could come back to those gap levels, but it's almost been more than a month that the stock has not filled that gap, which means that there is still strong demand for the stock which is coming by at every minor dips, and that itself tells you that the prospects of the stock going forward are very, very attractive. That gap generally acts as a support level. So what best I would suggest the viewer can look to do is you can start buying at current levels, maybe buy your 50% or your 75% of your expected quantity which you're looking to buy on Infosys at current levels, and if the stock provides any opportunity around that 850 or 880 zone, then look to add the remaining balance 50% at those kind of levels if the stock comes to those kind of strong support territory. I believe that the last 6 months or 5 months of price patterns and the trends which you've seen for Infosys, I think indicates that the stock is in for a multi-year uptrend.
Okay, thanks for that, Kunal. Sharmila, let's get in your take too on an Infosys, given where the dollar index is currently at, and also the outlook on rupee versus dollar. Do you think these IT stocks, and then particularly Infosys, are looking more exciting from a fundamental view?
So, the current rupee dollar situation could have added sort of little added interest to IT, but I think if you're a longer term investor and you're an investor looking to enter IT, then it's a good time, because once again, I think, as in the case of the earlier stock that we spoke of, SBI Life, here we have a business which really has sort of gotten its act together in the pandemic situation, and we have seen that working from home has been implemented extremely successfully by most of the IT majors, and they have really delivered. So I think, yes, if you want to enter Infosys, you can definitely enter Infosys. You need to be patient from a valuation perspective, because they are trading at those 25 times sort of multiples that most of the large cap ITs have been trading at. So it's not cheap in that sense, but the business is doing well and is expected to do well going ahead. So I am positive on IT. Probably the stock that I like best in the space is HCL Tech. But yes, I think if you want to enter Infosys, you can definitely think of it.
Consensus call coming from both of our experts on Infosys saying that you can look to enter that particular counter. And on that note, I'd like to thank Kunal Bothra as well as Sharmila for joining us on the show, giving us your take on the markets and also sharing with us your stock views with our viewers. But let's shift focus now, and here's a note coming in from the market veteran Sunil Subramaniam. He's saying that good companies in good sectors are trading at high valuations. Listen in to what else he has to say.
The good companies in good sectors are the one where there is fraud and the valuations are very high. Because the sectoral outlook is good and they are solid players there. There's no harm in that. And that's a price and a premium for quality which is being demonstrated. And those stocks in those sectors will not deliver you great returns, but they will give you decent, double-digit returns. But the real value, when you ask me from this, is that the very fact this is a very polarized rally means that there are a lot of good companies in sectors whose future outlook right now is not looking great. But if you just shift your lens to 18 to 36 to 60 months, you know that these sectors are critical for India, and the good companies there, unfortunately, because of this whole sector outlook, are not getting that kind of a flows, and their valuations are not that up. So on a broader market basis, I still believe that there is good value from a 3 to 5 year perspective to get phenomenal returns from the market. I think if you're going to chase the good in the good sector, right? I think that's where. I'm not saying chase good in the bad sector, but in those sectors which are cyclical, which we know that end of the day, Nikunj, the COVID crisis is not going to last for, let's say, 3 years, right? Whatever said and done, it's going to be cracked in, let's say, a year's time or maybe a year and a half time. But the core business of people going about their work, consuming stuff, factories being built, I think that factor is not actually coming through in the valuations because you see a sharp sectoral polarization in the valuation. So good companies in good sectors are the ones trading at high valuations. But I think there are a lot of good companies in the cyclical and those sectors which will definitely do well in the long run, where there is a good value pick. And I think that's what we are looking at in terms of our GARP approach, right? Growth at reasonable prices.
Okay, that was Sunil Subramaniam from earlier this morning. A lot of interesting insights came out during that interview. We have a lot lined up this morning, so let's get a move on. And we have the BNSN stock cloud, which we're just about to bring up on your screens. 10 stocks that are shining out for their respective reasons. Let's begin with an NMDC, which had a decent set of earnings, but quite a miss. Some people might say there was quite a profit decline over there, so just flagging that off for you. Then we have an Axis Bank and an IndusInd Bank. IndusInd more so for the FTSE exclusion. Axis Bank and Indus, though, yet both doing very well today and actually leaders among the Nifty pack. So seems to be quite a strong pipeline and demand for these banking stocks right now. Then the next two stocks are Future Enterprises and a Future Retail. We just told you Reliance is looking to complete the deal some point within the next 2 days. We're going to see Future Enterprises board meeting today. And it's supposed to be an all-cash deal, which will see Reliance take on the debt of both these entities. So let's see how that plays out. IDBI Bank is in there for a 6,000 crore fundraise that was just announced recently that they're going to be concluding. HCC and Mahindra Holidays yet again featuring on weakish earnings, although Mahindra Holidays has now reopened 20 resorts since the onset of the pandemic. Lastly, Sun Pharma had its AGM yesterday and they seem to have a lot of interesting products in the pipeline, and the chairman said that they seem to be leading the charge against COVID. And then HAL fell 15% actually yesterday because the government is mulling selling a 5,000 crore stake in that company, so that's got that counter in focus. Let's now cut across to Jayesh because August marked the third straight FNO series gain for the Nifty and the Nifty Bank. How are the FIIs positioned for September series? Jayesh will tell us.
The FIIs have positioned themselves on the long side because if you have a look at the FII net long position that they have built into index futures, that number has risen to as high as 75%. Remember that this is the highest level that we have seen in at least over a year. At the August series, we started at about 66% net long position. So there have been significant net longs that have been added by the FIs as well. Which also brings me to the point that with this number, what it means is that the market has actually become top heavy, and there could be very less room for error, or in case there is any negative news that could have an adverse impact on the market as well. And that is exactly what has happened in the past as well. Since 2012, if you have a look at how the Nifty has performed, every time the FI net long position has hit over 75%, we have seen an average decline of about 8 to 9% over the next couple of months. In fact, there have been 3 years where the market has managed to decline double digits as well, which is 2012, 2016, and 2018 as well, when the market declined more than 10% over the next few months. So given the fact that we are currently at about 75%, it will be very interesting to see how the market performs from here on.
All right, thank you, Jayesh, for getting us that ET Now insight. On that note, we'll slip into a break on this edition of Buy Now, Sell Now, but stay tuned, more on the other side of the break. Welcome back. You're watching Buy Now, Sell Now on ET Now, and let's get on with a stock that is in focus, or rather stocks that are in focus. You have Future Enterprises board that is all set to meet tomorrow, and looks like they're going to consider the Reliance Industries deal. My colleague Vinny is here to take us through the details and to tell us what should we expect from that board meet. Good morning, Vinny. Take us through the details.
So the much-awaited Future as well as Reliance Retail deal is set to be a part of the agenda of tomorrow's board meeting, where Future Enterprises in the board meeting is set to seal the deal with Reliance. Now, we have been hearing for a while that the deal is going to take place after Future Group was in the debt of around more than 12,000 crores. So surely that will be coming in tomorrow. Now, what are the transaction value of the deal is expected to be at around 29,000 to 30,000 crores. So how is this deal going to actually take place? I'll quickly take you all through that. Now, first, the step one will be Future Group will merge 5 of its entities, that is Future Retail, Future Lifestyle, Future Consumer, Future Supply Chain, and Future Market into Future Enterprises Limited. What is the second step? Future Enterprises will hive off the retail assets into a single unit and sell that to Reliance. So that is what Reliance Retail will be buying, the retail assets from Future Group. Now, obviously, how is the payment going to be done? According to the report, it suggests that 13,000 crores will be for the Futures Group debt, while around 7,000 crores is going to be for the liabilities, as well as 6,000 to 7,000 crores will be to the promoter group. So obviously, Reliance will be picking up around 14 to 16% stake in Future Enterprises for a value of 3,000 crores through a preferential allotment of shares. So that is something interesting, and we'll keep an eye out on all the details also as well tomorrow. Now, obviously, this is going to help Future Group pay off its debt, but how does it help Reliance Retail? As the acquisition will give it a wider control of around 1,800 stores, as well as it will bring 26,000 crores of additional sale that will help Reliance get control for more than 1/3 of the country's organized retail market. So surely we are going to wait out for the further details as well, and how the deal actually pans out, and we'll keep a close eye on the deal tomorrow.
Okay, Vinny, thanks for that very important update rather. So we'll be tracking that one closely. I think we've shared a lot of the details with you. We're just waiting for this deal to get completed now. It's been talked about for so long. Coming back to banking a little bit, FTSE, the FTSE, has deleted HDFC Bank, Kotak Bank and IndusInd Bank from its inclusion plans. Now, just to give you some background, they had decided that they would include these stocks post when the FII limits were raised by the government not too long ago. Now what's happened is, for failure to meet the minimum headroom requirement for foreign investors, they've had to cancel this addition. So there's going to be no selling, as there was no inclusion, but there might have been investors who, in anticipation of this inclusion, which, by the way, was supposed to bring total flows of $1.4 billion to these 3 banks. HDFC around 450, Kotak around 150, and then I think IndusInd Bank was also supposed to see quite a large inflow. Between the 3 banks alone, there was expected to be around 740 million of additional flows. So that's what's now going to be missing. So, people were anticipating a knee-jerk reaction this morning. They thought that all this buying that's been happening, because HDFC is up 3% this week, Kotak was up around 6%, and IndusInd was up around 17%. So investors thought that there might have been a knee-jerk reaction. Surely there has been some, but nowhere close to the extent that we might have imagined. And in fact, IndusInd Bank is leading the Nifty yet again today as one of the top performers. So definitely not a good thing for them, but at the same time, nothing earth-shattering, which is really going to hurt the prospects or the valuation at this stage.
Now shift focus to Hindustan Aeronauticals and the OFS, and what's the latest on that particular front? My colleague Ruchi is joining us on the phone line. Ruchi, you have HAL OFS, the portion open for retail subscription today, and what's the latest that you're picking up on that? Ruchi, I believe we've lost Ruchi's line, but just to take you through, the HAL's OFS, the institutional bucket, has received good response from the markets. Institutional portion of the HAL OFS has been subscribed 1.6 times. Remember, like I mentioned earlier also, the portion is open for retail subscription from today. Retail participants to get about 5% discount over OFS price. So that is the latest coming in for HAL. Remember, yesterday the stock had fallen about 15%, but Ruchi is here with all the details. Ruchi, take us through the latest on the HAL OFS.
The government is looking at the disinvestment process for HAL. They, remember, had said that they will be coming out with the OFS, for which the institutional, the institutional subscription has received a stellar response. In fact, not just from mutual funds, but from HNIs, FIIs, from various big institutional players as well. So the institutional portion has been subscribed about 1.6 times today. The issue is open for retail participants. Remember, as against the OFS price of 1,001 rupees per share, the retail participants will be able to get a pie of HAL OFS in 950 rupees per share. So it is important to note that today is the day for retail participants. All in all, the government is receiving a stellar response for the OFS for HAL.
Okay. Thanks for that, Ruchi. Very interesting update. HAL in focus on the back of this big OFS that the government's planning. But another stock that's in focus is Godrej Properties, and that's because the CST, the stamp duty rather, was lowered, particularly in Maharashtra, from 5% to 2% till the month of December. So that's expected to accelerate retail sales here, at least in the Tier 1, quite a bit. So Pirosha Godrej, who's the executive chairman of Godrej Properties, is talking to ET Now earlier this morning on how realtors can cope up with the pandemic fallout. And he was actually chatting with Abha and also discussed a fair bit of where we are in the revival cycle. Let's listen in.
But, I'd put it in two ways. One, I think there's no question the situation, both the current COVID pandemic, but also the overall weakness in the sector going into this, has made absolute sales more challenging for everyone in the sector, including us. So I think our numbers would be even higher were market conditions favorable. But I think there's no question that on a relative basis, which market share would indicate, this has advantaged the stronger developers with strong brand names, because in any case, I think customers for under construction real estate over the last few years have seen a lot of different things go wrong when buying homes, huge delays, in certain cases, developers going bankrupt before being able to deliver the home. So I think there was already a significant amount of conservatism coming into the buyer's mind on which set of developers they want to work with. And obviously, I think a situation like COVID, which has put many businesses under financial strain, and has clearly, I think, clarified to customers the even greater importance of only working with developers whose financial stability they are confident in. So there's no question that I think the leading players, including Godrej Properties, will significantly benefit from a consolidation perspective. That consolidation has already been playing out over the last 5 or 7 years quite significantly, but I do think this situation will ensure that process gathers further momentum.
Sure. You did face, as everyone did, challenges, in the beginning when the lockdown first hit with regards to construction, which put a spanner in the works in terms of completing things on time. As labor comes back to work, how are things looking now on ground?
So I think, it's been quite positive, the change. We actually were quite concerned in the first quarter because what we saw was actually that we managed to retain well over 60% of the labor on our side through the actual lockdown. And, we're able to, of course, make sure they stayed as comfortably as possible during that. But what happened after that was that everybody wanted to return to their homes to see their family, I think, after an event like this. So we saw that 60% number go down to below 30%. And that's been steadily coming up since June. And the most recent number is now north of 70%. So I think we're in a reasonably healthy zone. I think in another 3 or 4 months, we should certainly cross the pre-COVID labor strength. I think that said that, there will be a setback to construction schedule.
All right, on that note, we'll slip into a break on this edition of Buy Now, Sell Now. But stay tuned. When we'll be back, we'll be speaking to Rashesh Shah of Edelweiss Group.
Management, Rashesh Shah, who's the chairman and CEO of the Edelweiss Group, is now with us. Good morning, sir. Welcome to the show. Thank you for taking out the time to chat with ET now. So, let's begin with the most recent news. How do the EFSL shareholders benefit from this partnership? Wouldn't listing the wealth business unlock shareholder value as well? And how does the majority stake here help?
Absolutely. As you see, over the last few years, we have been working on 2-3 parameters. One has been to make the businesses more simpler. We are a diversified financial services group, and we have asset management, wealth management, retail credit, wholesale credit, life insurance, general insurance. These are the 6 verticals in Edelweiss, and our approach has been to make this more and more simple. So as you know, about a year and a half ago, we had put asset and wealth management together and basically carved that out of the other businesses of Edelweiss. And now we are carving out the wealth management. So idea is that each of this business is now of a significant size and scale, like the wealth management business, which is only one of the 6 businesses in Edelweiss, is now valued at 4,500 crore in this transaction. As a result of that, our idea would be to get this to a demerger, get it listed, and give free shares to our shareholders so that the Edelweiss shareholders can have direct ownership in the exciting growth of the underlying businesses. So I think idea is to make the business a lot more simpler, create the pieces which are still have a lot of growth ahead of them, and enable the shareholders to participate directly in that.
All right, so thanks for stating the value proposition there. But, talking a little bit about the investors, Edelweiss has at various points brought in global investors. This definitely wouldn't be the first time. So we've seen it quite consistently over the last few years. What was the particular chain of thought or thought trend behind this particular investor, apart from the fact that they can bring in capital, of course?
So, as you know, we started Edelweiss 25 years ago with only 1 crore of equity capital. We are all first-generation entrepreneurs. We are all professionals. We are not part of a big business house. So we don't have capital sources that we can keep on injecting capital. We don't have multiple businesses where we can release capital and put. So Edelweiss, we started with 1 crore. In this Edelweiss wealth management business, we started this business about 20 years ago when we acquired a company called Roshni for about 8 crores. And that 8 crores of investment we made 20 years ago is today worth 4,500 crores. So the approach is that we can build businesses if we can get partners who can bring in capital, because as you know, financial services needs people, great management team, great culture, but also capital. So our approach has been, we bring all the other strengths in India, and if we get the right partners who bring in the capital support to this, the businesses can grow a lot. And that is what we have demonstrated again and again in our asset management business, in our ARC business, in our life insurance business, where also we got Tokio Marine as a partner, and that business has been growing very well, including in this first quarter. So our idea is that being professionals, being first generation entrepreneurs, we should partner with people who have the capital, and we bring in our management team and the Edelweiss culture to build some great businesses. And this Edelweiss Wealth Management is an example of that. This is one of the 6 businesses we have. And as I said, we started this business 20 years ago with 8 crores of capital. So 8 crores of capital, if we can convert it into 4,500 of value now, with a lot of growth available in the future, and now distribute our holding to our shareholders so that they can participate directly in a standalone independent entity. I think it's a great way of building businesses and rewarding shareholders.
Good morning, Mr. Shah. This is Cheryl also joining in. Your wealth management business has been doing extremely well. So why do you feel that this is the right time to bring PAG on board?
So I think PAG is a very leading franchise in Asia. They have invested in financial services business across Asia and done very well. When we talk to their investee companies, they've added a lot of value. So I think private equity firms, good quality. And in this deal, at least we were very fortunate. We had choice amongst 2-3 of the leading private equity firms who were keen on that, because they can help you build these businesses. They can provide capital support, obviously is required, but they can also bring the professional rigor, the governance structure to take it and make it independent. Currently, if you look at Edelweiss in the first 25 years, we've been like a joint family system. All the businesses have been housed under the same umbrella, and we have grown very well. We built some great businesses. But the stage at which we are now, when we look up the next 25 years, each business now needs its own space to stand on, its own capital availability, its own structure, its own maybe listing in the market. And having a good private equity partner, somebody like PAG, will allow this business to not only grow a lot faster, but go to its own logical conclusion. It also gives us a lot of capital and currency for acquisitions if you want to make that. So this is truly the time where, your kids have grown up and now they need their own independence. And we at Edelweiss have always been very amenable to that. We don't believe in keeping things under the same roof. If the business can grow much better with a strong partner, with being independent, it will be a great value added for everybody, including Edelweiss shareholders and the management team. So as you see, this is a very unusual decision. Usually spin-offs and demergers are not a very usual decision because you lose control in that. But we think control is not as important as value creation and growth. And getting a good partner allows us to take it to the next higher heights in this business.
Mr. Shah, are you actually looking at more such transactions in the future as well?
I think, as you know, the last couple of years, all of us have needed capital, and because of COVID, we are seeing all the banks are also raising equity capital. So this transaction also gives us equity capital at a group level, also allows us to continue to make investments in other businesses which are in their growth phase. I think after this, we should have more than sufficient capital. As you know, our capital adequacy is very high. We have enough liquidity on the balance sheet now. So I would feel after this, our needs are done. But in a lot of this, we don't do this only for capital. As I said, you need capital, you need a great partner, you need the ability to build business independently. So we always look for partnerships. So in the businesses, in specific businesses, we'll always be open to partnerships. A lot of people approach us, and we do believe that the best way to build businesses is having great partners who bring the capital strength, expertise, strategic focus, and allow the businesses to grow on their own. Because independent partners also bring a lot of strategic focus to their business, because like PAG will focus on how do we grow the wealth management business. Edelweiss has a lot of businesses, so we spend so much attention on each business. But having a dedicated partner who's put a lot of money into the business, they will be very focused on growth of this particular business, and that itself is a big advantage, because as you know, management bandwidth and focus is as important for scaling up businesses as anything else. So currently we will have enough capital, we'll have enough liquidity after this, that we have enough growth capital for all of our businesses for the next few years. We wanted to be capital surplus, and with this deal we will become capital surplus. So having got that out of the way, we will always be open to partnerships, but for various other reasons.
Right, Mr. Shah. You know, you just mentioned we have enough capital. The capital adequacy is fine. So, you know, keeping it with this theme and subject, we wanted to get a sense from you of banks fundraising. Now, why are banks then, who have similar prospects that you just mentioned, sufficient capital adequacy, no real urgent growth capital required, so why are they raising money? And is it because credit cost is spiking? And if credit cost is not spiking, then why are they raising money?
I think everybody is doing two things. I think one is, as you very correctly said, I think people are, building defenses for any spike in credit costs. We do think that there will be an increase in impairment and credit cost. It will be about 1 to 2% of their total assets. And if you see, most of the banks are raising 2 to 4% of their assets as equity. So I think banks are raising enough equity to take care of the increased impairment. It will not be a crazy amount, but it will be 1 to 2% of their total assets across the board. This is a very broad approximation I would give. I think we are also, like at least in Edelweiss, we are raising this money also for future growth. A lot of our thinking has been post-March 2021, because as you know, COVID will get over at some time. At some point of time, there will be a vaccine, COVID will get over. From that point of time, when growth comes back, how strong are you? Because coming out of a crisis, if you have enough resources, enough capital, it's much easier to capture growth. So our whole focus has been March 2021, by which time we feel COVID will be behind us. Do we have enough ammunition? Do we have enough financial strength? Do we have enough ability to really capture growth when it comes? And I think a lot of this equity raising is also for that, not just for the COVID impairment, but also with an eye to future growth, because having capital, having businesses which are aligned for growth, having a strong balance sheet will be a huge factor when growth comes back again.
Mr. Shah, all the markets have recovered. So can you talk about funding of MF for bond markets, also the difference from AAA and A? And do you actually think that it needs to correct for the NBFCs to grow once again?
It's starting to happen. I think it will take time. You are very right. I think and you said between AAA and A, but I think between AAA and even AA, the spreads are much higher than what they should be normally, because I think markets have got dislocated. See, India still doesn't have a very evolved bond market, and this is all bond market. So if you look at bank credit, has been flowing very well, and banks are having a lot of liquidity. We ourselves have raised a lot of liquidity from banks in the last couple of months. Bond markets are still very dislocated. There is a panic, and after the incidents in the mutual fund where some funds were closed down, there is a sense of panic out there. And what happened 2 years ago with the ILFS, which was an NBFC kind of a liquidity crisis, got translated into a bond market liquidity crisis. And I think that just happened a few months ago. So I think it will take another couple of quarters for bond markets to come back to normalcy. But at the moment, bond markets are very dislocated. There is a lot of irrational pricing also still visible in the bond markets. And I think this could be an opportunity for India to really get the bond markets also deep and liquid and get there, because we can't only work on the bank market. We need the bond markets to work well. But currently, bond markets are in a sense of there is a panic, there is a fear, there is a complete risk aversion out there. And I would say in any economy, it's not normal times for bond market when a AAA can raise money, but the normal times are when a BBB can raise money. So when you said NBFCs will be able to raise money at will, I don't think it's just about NBFCs. When a BBB, because a BBB is also investment grade. So when a BBB can raise money, a company like us, which are AA minus rated, we should be able to raise money at free. But even lower rated companies, which are investment grade, should find it easy to raise money at a price. And that I think is at least another 2-3 quarters away. I hope our bond markets recover, because that will be very critical for the economy to start growing.
So leading on from what you just said, can you talk about this risk aversion in bond markets a little more? Do you think there's perhaps a panic which got created so that maybe this marks the bottom and in future investors will emerge stronger? Because the underlying financial strength of some of these lower rated corporates is still pretty decent. So why should it be so difficult for them to raise money?
Absolutely. I started my career 30 years ago, and in 30 years I've seen a lot of upheaval in Indian markets, in the banking sector, in the equity markets, in the bond markets and all. And one thing has been unequivocal, one thing has been sure all the time, that whenever there has been a crisis, India has actually become stronger after that. So every time there is a dislocation like this, there's a crisis like this, it is an opportunity to clean up a lot of things, to make structural changes and take this market to a greater height. So I do think the troubles of the bond market, the mutual fund industry and the bond market of late are a great opportunity for us to go down to the basics, think about what is required to build really breadth and depth in the bond markets in India. And I do think I've seen this in equity markets very often. We have had our own crisis in equity market, but at the end of every crisis, equity market has become stronger. And I do think this crisis in the bond market is also a great opportunity to revive. And as I've said, this is a liquidity crisis. I think from a credit cost point of view, a few companies will default, but usually anywhere in the world, that is usually the portfolio effect takes over. It's like when you buy a portfolio of equity shares, some will do well, some will not do well. The same thing happens in should happen in bond markets. But I think our investors, also media, I must say, that they can create a lot of panic, that any upheaval in the bond market is seen as a big crisis and it is played up and all. I think there will be maturity, calmness that will come to the market. And as it comes, I think a new era for bond markets will start in India. I do think the next 3-4 quarters, RBI, SEBI, regulators, government, everybody will work together. There's a lot of thinking going on. And I remain very confident that the learnings of the last few quarters will be very useful in building a very robust bond market.
So Shah, we leave it at there. Thank you for joining us and giving us the details and the rationales behind the PAG deal, also talking about the bond market with us. Let's shift focus now to an ET Now exclusive. Earlier this week, a veteran banker, KV Kamath, told ET Now that the RBI appointed committee is working overtime to submit its recommendations on the one-time restructuring policy before the September 6th deadline. ET now exclusively learns from its sources that the committee is working with 12 banks and accepting recommendations from various industry associations in the run-up to the deadline to submit the report. My colleague Priyanka Iyer is joining us with the details of the story. Good morning, Priyanka. Take it away.
Well, yes, the KV Kamath committee is working full steam, and what we are understanding from sources is that the committee is in consultation with 12 banks to understand and make the contours of the debt recast plan, the one-time loan restructuring that the RBI has come up with. Now, these 12 banks, we understand, make up 60 to 65% of the total exposure to COVID-19 impacted loans, which may require the one-time restructuring once the moratorium period lifts. Very importantly, we are also understanding from sources is that the KV Kamath committee is in the process of taking consultations from associations of various sectors like real estate and power, etc. They have also taken presentations from rating agencies like CARE, CRISIL and ICRA. The Indian Banks Association had laid down a list of 26 sectors is what we understand, on which these credit rating agencies are doing their presentations. They're giving the views on the health of the sector, which sectors will require more help after the moratorium lifts, and which sectors are in good health right now and may not require a lot of hand-holding from banks. The other important point that the committee may suggest to the RBI is the RBI had said that 1st March is when the loans that will be restructured, they should be either standard or they should not be overdue for more than 30 days before the 1st of March. They may suggest increasing the number of days from 30 days before the 1st of March. But remember, any of these things will still be recommendations by the committee, and the final call will be taken by the RBI on how the debt recast and one-time restructuring plan will go forward.
All right, that was a very interesting update from Priyanka. Thanks for bringing that to us. And on that note, we're completely out of time here on Buy Now, Sell Now. So bye from Cheryl and me. Keep it with ET Now for Markets at Noon coming up next.